What's going on, guys? Broke Investor here, back to YouTube. Alright, I'm going to try to be a little consistent this year, and as you can see, I have for those of you who've been watching my channel, I have a different background than usual. So obviously I mentioned I moved, so I had to change things. No more chalkboard. I decided to get a whiteboard and, you know, use the same idea, but obviously, you know, it'll look a little different. Anyway, which makes me think I should probably start with the basics. And I'm going to kind of redo a lot of videos I already did to hopefully gain, you know, new subscribers and hopefully keep the same ones and better explain what I did in the past, because obviously I've learned a lot over the years. So some of what I mentioned in the earlier videos probably wasn't as great content as what I can produce now. So anyway, this video is a dividend investing for beginners video. As you can see, dividend investing basics. So I just want to go over a few things, keep it simple, and then end the video. So let's get to it. So we'll start with what you need. First of all, you need an adult. So if you're not 18 years old, you can't open a brokerage account. So you obviously need someone to sign for you. You know, you need someone to sign up for the account for you. If you're a minor and you're actually considering this, bravo to you, because that's amazing. When I was that age, you don't even know what I was thinking. But I know times have changed, technology, and people can, you know, find out more things, which wasn't available back then. But anyway, if you're not 18, obviously you need an adult. Number two, you need a brokerage. This is important, but I always tell people, they ask, where should I open this account, that account? I always say, who do you bank with? And, you know, start from there. Because obviously if you bank with someone, you trust that company. So start with your bank. Do they offer a brokerage option? And if not, go from there. You know, look online, check other places, get reviews, things like that. I use Robinhood from day one. I still do. I use a couple others. Fidelity is one that everyone praises. I use that as well. And, you know, can't complain about either. So it's really up to the user. I mean, they all have the same insurance, the SPIC insurance. So as long as that's the case, up to you. Number three is the will to learn. So I wouldn't recommend even doing this unless you have the motivation and the, you know, the drive to learn, because it's going to be ongoing. You can't just say, okay, you know, how do I do this, do it, and then that's it. No. Things change, companies change, everything changes. So you have to stay on top of things. You have to stay on top of the news. It's ongoing, and it's fine because that's your money. So you should be motivated to learn. So, you know, you figure once your money is committed into something, which it's possible you could lose your money, you're going to follow that. You're going to, you know, you're going to keep on top of that. So obviously you need some drive. You need the will to learn. You know, books, read online, however you do it. Listen to podcasts, listen to my YouTube and others, obviously. Number four is you need a plan. Now, to me, you probably might have a plan right away. So, which is fine. You need to eventually have a set plan. Like, why are you doing this? Why do you want to invest in dividends? You know, what is your plan? Do you plan to retire on dividends? Do you plan to use it as supplemental income? Or do you plan to just have fun and invest and hope for the best? I mean, I think you should have a specific plan and draw it out. My plan is it's still to retire on dividends. I mapped it out. It's not really, I'm not sure about it, but it's looking like it may just be supplemental income to my 401k, but I'm still hoping that I can actually live and retire on dividends. Obviously, I'd have to, you know, switch things around, maybe live a little less. I wouldn't have to have children. I wouldn't have daycare to pay for at that time, but anything's possible. So that's it. That's pretty much all you need. And as you can see, I have a note here, and it deserves its own box. If you're just starting out, do not chase yield. Don't chase yield, don't chase yield, don't chase yield. I know it's tempting, but don't chase yield. What that means is don't automatically look for a stock and invest in a stock just because it has a high yield, because it pays out a high dividend. It may not be able to afford that dividend. Maybe it can, but the point is, don't just look at high yielding stocks, because in the end you may get burnt. You may be making this pretty yield each month, a nice dividend, but sure enough your capital could go down, the company could tank. Who the hell knows? So anyway, I'm going to say that a couple times in this video. Don't chase yield. I did in the beginning. It was a mistake on some, not on others, but it's stupid. So back to the basics. What is a stock? A stock is a type of security that signifies ownership in a company. Simple, right? So a lot of companies that you come to know are public. So if a company is public, you can buy a share of their stock. A dividend. What is a dividend, right? What's the whole point of this video? It's a sum of money paid by a company, public company, to shareholders. So a lot of companies pay dividends because their shareholders want to be rewarded for investing in that company, and rightfully so. I'm giving you my money. What do I get in return? I want an actual income. Why would I invest in a company, own a portion of that company, and get nothing in return? I don't want to have to rely, me personally, I don't want to have to rely on making money only when I sell. So I have to rely solely on capital gains. I want to buy a portion of the company, I want to hold that company, and I want to get paid my dividends. What will I do with those dividends? Maybe I'll buy more shares of the company. Or maybe I won't. Maybe I'll put it elsewhere. But I want to get something for owning a portion of the company. Now, there's a lot of people that are going to say, buy growth stocks, buy growth stocks, buy growth stocks. A lot of the dividend stocks are growth stocks, like Apple, Microsoft, a lot of the tech stocks. They do pay dividends, and they are high growth. Obviously, you can make a lot of money on Tesla, Amazon, things like that, because they do not pay a dividend. But you only make money when you sell. Keep that in mind. I personally, I want to invest in a company and just leave the money there, and then I'll get the dividend. That's it. Because I'm a long-term investor, I don't care. I don't want to sell I don't want to sell the stock that I'm buying. I will if I have to. If the company does, goes crap for a couple years, I may have to, but I don't want to. When I pick a company and I invest in it, I want to hold that. I want to hold those shares for a long time, and I want to collect those dividends for a long time. It's also a hell of a lot easier. You buy it, you leave it. That's it. Set it, forget it. Hopefully. Not really, but anyway. So I wrote down a couple other terms, pretty basic terms that you should know as a dividend investor, especially if you're just starting out. The dates. The most important date is the ex-dividend date. So the ex-dividend date is basically, that's the date where you can no longer qualify for the following dividend. So if you own a stock any day prior to the ex-dividend date, any business day prior to the ex-dividend date, then you will get the following quarter's dividend or monthly dividend, however often that they pay. So if you own it on ex-dividend date, if you buy it on ex-dividend date, you will not get the dividend. So you'll have to wait to the following quarter. Keep in mind, you can't just buy a company for the dividend and sell it on ex-dividend date or after, because the stock will go down for that amount of the dividend paid. So typically that does not work out for people. It may. It's called dividend swing trading. It may work out for some people, but keep in mind with that, you will pay short-term capital gains tax. So that also matters, because when you own a company, say I believe for 90 days or more, the dividend could be a qualified dividend, which means you pay the normal capital gains tax. If you pay short-term capital gains tax, that's the normal income tax bracket, which usually varies from 5 to 7% difference. So if you can save money on taxes, why the hell not? Next one is declaration date. That's when the company basically declares the other dates. Record date is when the bookkeeping happens. They actually take a record of everything. This is how much we're paying. This is who we're paying it to. I look at it as that's when it shows as my pending dividend in Robinhood. And payment date is obviously the date it hits your brokerage. When you get paid a dividend, you have the option to choose reinvest or sum of cash, whatever it says on your brokerage, I don't know. If you reinvest, it'll buy a fractional share or whatever, whatever that dividend's worth, it'll buy that portion of a share of that same company. If you do not reinvest, that money will just go into your brokerage balance, and you can do what you want with it. Market cap. I wrote this because it's important for you to know, because you may want to invest in big companies. So market cap is basically the market value of companies' outstanding shares. It's what the market says the company's worth. So you take how many outstanding shares there are and times it by the price, and that's what the company is worth. Obviously, the Apples and the Microsofts, these are $1 trillion market caps. These are huge companies. If you invest in a huge company, you feel a little safer, right? Maybe so, maybe not. But you may be overpaying at the same time. So, anyway, market cap is, there's classifications. There's small cap, there's mid cap, large cap, mega cap. So, you can look into that too. EPS is also important, earnings per share. Typically, most companies, they have to do a quarterly earnings, and they'll tell you every quarter, this is how much we earned per share. And again, this is important, especially as it relates to the dividend, because the earnings per share should be greater than the dividend. Because if this is how much they're earning per share, obviously they're paying this amount in dividends per share, you want the EPS to be a lot greater than the dividend, which shows you that they can afford to pay that dividend. Hopefully now, hopefully forever. But you can't predict the future. Next is yield. Yield is how much is paid per year relevant to the share price. So total dividend divided by share price. That's your dividend yield. As I mentioned before, do not chase yield. So what's a respectable yield, what's not? That's really up to you. It's really up to how much time you have, and what your goal is. But I always look at it, anything less than 2%, it's kind of like tough to get anywhere with that, right? So, depending on the growth rate too. So I look at 2% or more typically. I would do 1% if the growth rate's there, but I would probably be weary of anything paying more than 8%. And I say 8%'s high, but companies like Altria, they're at nearly 8% or more at this point because the stock price has been down. But I do trust that company. So it depends. All scenarios are different, but typically 2 to 3%. If you see that yield, it's more than likely, it's probably safe. It all depends on the company, but again, if you don't chase yield, if you really do not focus on yield in your research and picking a stock, it will help you for the long term. But at the same time, you want the company to pay something. You want the dividend. You don't want a shit dividend. You want a respectable dividend. If they're paying less than 1%, what the hell? Come on, raise the damn dividend. You can afford it. Payout ratio, I think I mentioned this kind of before. It's the total paid relative to their income. Income meaning, so as I mentioned, the EPS. So when you divide EPS into total dividends, that'll be the payout ratio. You want the payout ratio to be less than like 70%. So you don't want to pay out more than 70% in their EPS to dividends. So, if the dividend is, if the earnings per share is, if it's $1, whatever, and the total dividends per year is 70 cents, that's 70%. That's what you want. Things like that. If they're paying $1 in dividends and they only earn, $1 earnings per share over the year, that's 100%. That means they have nothing else, no other money for anything, So there's no money to invest in the company. There's nothing. So that means also it can't increase their dividends. So you want there to be room for dividend growth. So you want the payout ratio to be less than 100%, hopefully less than 70%. Growth rate, last but certainly not least, and yes, this should be part of a dividend investing basics video. This is very important. I kind of I wasn't really looking at this in the beginning, and I do regret it. I had to eliminate some stocks, but the growth rate is the annual percentage rate of growth for the dividend. So If you look, you've probably heard of the Dividend Aristocrats, Dividend Kings. These are companies that have paid and increased their dividend year over year, for that however many years. Dividend Aristocrat is 25 years plus. But you can't just look at that. You want to look at how much have they increased it over the years. Have they increased it 5%, 1%, or they increased it double digits, 10% maybe, 20%, or it depends. But I'm looking, me, again, personally, and you do whatever the hell you want, but I want at least 8%, 10% hopefully, but at least 8%. I do invest in companies that do not have that growth rate, like AT&T. They have a high yield, which I like. Kind of balances out my low yielders. But I do believe in the company. They're, an income powerhouse. They have a lot of debt. They're working on it. A lot of people hate AT&T. A lot of people love it. It's a love-hate thing. But companies like that, to me, they have already a great starting yield. So you don't need that much growth to have, because you're already making, say, whatever it is now, I don't even know, 5-6% off the bat. Versus, say I invest in a company like United Healthcare, UNH, they have like 15 to 20% dividend growth rate. Amazing. But the yield is 2% or lower. So it's going to take you quite a few years to build up to that 5 or 6%. However, once you get to that, on and on, the limit is endless, especially, companies that can afford it. So growth rate, like I said, is very important, especially if you have the time. If you're retiring next year, you should still care about growth rate, but obviously you're going to care about yield a little more because you need that income now versus later. If you're, say, in your 20s or, however old you are, and you have 20, 30, 40 years, keep an eye on this and don't even look at the freaking current yield. You don't need the money now. Look at this. What has their growth rate been? Can they afford do they have a low payout ratio? Do you think if you're going to get 10% increase year over year over year, your yield on cost, I don't even have that on here, but your yield on cost, which basically it's total dividends paid versus your original purchase price, will be insane. Maybe even 100% one day. So 100% return on your investment if you do have that time. But typically I'm trying to get to 10% hopefully before I retire. My average yield for all my stocks, yield on cost, is around 4%, a little more than that. But keep in mind I'm investing each and every day, and I'm going from there. So that's the dividend investing basics. I'm the Broke Investor. This is my YouTube channel. I'm going to try to be a little more consistent in the future. I plan on, I don't limit it to dividends. I'm probably going to talk some options later on. I don't know, whatever the hell you guys want to hear, please leave a comment and let me know. I do it based on the feedback, whether it be on here. You can reach out to me on Instagram too, _broke_investor. I try to speak the people's language. I'm not throwing out, any complicated terms here. I'm talking the basics because when I started, I knew nothing, I'm still new and I'm still learning every day. And I'm just starting, I'm reading a lot of books. I'm learning more and more each year. So I'm trying to share for the people like me who may have, just starting out and they want to hear from a real person. So yeah, my strategy is dividend investing. I invest in dividend-paying stocks, in a Roth IRA, and a taxable brokerage, and obviously my 401k even has dividends. So one day I'm going to retire on the dividends. Hopefully most of it will be in my taxable brokerage, but the Roth IRA has limits. You can only do $6,000 per year contributions, so you can open one per person. If you're married, you can open two, assuming you are within the income limits. But yeah. And we'll get into Roth IRAs later. But anyway, I'm not a financial advisor, obviously. I'm a broke-ass investor. This video is, for fun and entertainment. If you want to invest, obviously, consult with who you have to. Do your own research. Do what you got to do. But, I'm here to do the basics with you. So I hope you guys enjoyed this video. And leave a comment. like, subscribe. I would greatly appreciate it. And share with your friends. Tell your friends, tell your friends. All right, later.